If you have ever placed your trust in a company's earnings report and then watched the stock price crumble within months, you already know the pain this work was written to prevent. That pain is felt by investors in every country, across every market, at every level of experience. And almost always, the root cause is the same. The earnings that looked so strong, so solid, so reliable, were not what they appeared to be. The numbers were not false in the criminal sense, but they were shaped, molded, and carefully presented in a way that hid the real picture from anyone who was not looking closely enough. Thornton L. Glove spent his entire career doing what most investors never bother to do. He sat down with financial statements, turned every page, and studied every footnote. He asked the kind of questions that most people on Wall Street never ask. His goal was simple but incredibly powerful. He wanted to know whether the earnings a company reported were real, not just technically accurate, but genuinely reflective of the true economic condition of the business. And what he discovered, over years of this kind of deep and careful analysis, became the foundation of what you are about to absorb today. This is not a lesson in theory. This is not abstract finance that lives only in university classrooms. This is practical, battle-tested knowledge for anyone who puts money into the stock market and wants to come out ahead. Whether you invest a little or a lot, whether you are just starting out or have been at this for decades, the principles in this work can change the way you see every financial statement you ever encounter again. And once you see these things, you cannot unsee them. So let us begin at the very beginning. Let us ask the most important question in all of investing. What does it really mean when a company says it made money? Every quarter, companies around the world release their earnings reports. The financial press covers these announcements like sporting events. Analysts on television declare winners and losers. Stock prices jump or fall within seconds of the announcement. And at the center of all of this excitement is one number: earnings per share. This number, more than almost any other, drives the short-term behavior of stock prices. It is treated as the definitive measure of how well a company is doing. And most investors accept it at face value without ever stopping to ask a deeper question. But O'Glove asks that question, and the answer changes everything. Earnings per share is not a single fixed measurement like the temperature outside or the weight of an object on a scale. It is a number that is constructed. It is built using accounting rules, and those rules give companies a significant amount of choice in how they present their financial results. Two companies can have the same underlying economic performance and yet report very different earnings figures simply because they made different accounting choices. And on the flip side, two companies can report the same earnings per share number while being in completely different states of financial health. This is the central insight of the entire work. Reported earnings are not the same as economic reality. They are an interpretation of reality, shaped by accounting conventions, management choices, and sometimes a very deliberate effort to present the best possible picture to investors. The investor who simply looks at the earnings per share number and says this looks good is missing most of the story. The investor who understands quality of earnings, who knows what to look for beneath the surface, sees the whole story. And that investor makes far better decisions. Now let us understand what the phrase quality of earnings actually means, because it is the core concept around which everything else is organized. When analysts and accountants talk about quality of earnings, they are asking a fundamental question. Are these earnings durable? Are they real? Are they backed by actual cash flowing into the business? Or are they the result of accounting choices that can make performance look better temporarily, but that do not reflect what is truly happening in the underlying business? High-quality earnings are earnings that come from the real, ongoing operations of a business. They are consistent from period to period. They are backed by cash. They are not dependent on one-time events, asset sales, changes in accounting methods, or other non-recurring items. A company with high-quality earnings is one where what you see is genuinely what you get. The numbers and the reality are aligned, and that alignment is stable over time. Low-quality earnings are the opposite. They may look impressive on the surface, but when you dig deeper, you find that they are built on accounting choices that cannot be sustained. They may include gains from the sale of assets that the company does not sell every year. They may reflect a change in how the company accounts for its inventory that made profits look bigger this year but will not help next year. They may come from cutting expenses in ways that damage the long-term health of the business. Low-quality earnings are like a beautiful coat of paint on a crumbling house. From the street, everything looks fine, but up close, you can see the cracks. And here is the critical point that O'Glove makes over and over again. The stock market, especially over the short term, often rewards low-quality earnings just as generously as high-quality earnings, because most investors do not bother to look beneath the surface. But over the medium and long term, the truth always comes out. The house that was only held together by paint eventually falls down. And when it does, the investors who never looked past the surface are the ones who get hurt most severely. So knowing how to assess the quality of earnings is not just an academic exercise. It is a survival skill for every serious investor. And the knowledge that O'Glove provides is not secret, not reserved for professionals, not behind any wall of privilege. It is available to anyone willing to do the work. That is what makes this framework so democratizing and so empowering. The first and most important tool in this framework is the cash flow statement. If there is one lesson from this entire work that you carry with you, let it be this: follow the cash. Cash is the one thing that companies cannot fake for very long. It is either there or it is not. And the relationship between reported earnings and actual cash generation is one of the most revealing things you can study about any company, in any industry, in any part of the world. Let us think about this clearly. When a company sells a product and collects the cash immediately, that is a clean, straightforward transaction. Revenue goes up, cash goes up, earnings go up. Everything is aligned. But what happens when a company sells a product and records the revenue today, even though it may not collect the cash for 90 days, or 180 days, or even longer? The earnings statement says the company made money, but the cash is not there yet. And there is always a risk that the cash never arrives, because the customer may not be able to pay. This is just one of many reasons why earnings and cash can diverge. And O'Glove was one of the early voices in the investing world to emphasize that this divergence is a crucial warning sign that demands attention. When a company's reported earnings are rising, but its cash flow from operations is flat or falling, something is wrong. When earnings and cash are both rising together, that is a sign of genuine, durable business performance that deserves the confidence of investors. The tool for measuring this is the relationship between operating earnings and operating cash flow. The basic concept is simple enough for any investor to grasp. You look at the earnings the company reported, and then you look at how much cash the business actually generated from its operations in the same period. If those two numbers are similar and moving in the same direction over time, the earnings are likely of high quality. If they are diverging significantly, and especially if earnings are much higher than operating cash flow on a consistent basis, that is a red flag worth investigating before making any investment decision. O'Glove illustrates this principle with many real examples from his career on Wall Street, and the pattern is consistent. Companies that reported beautiful earnings while generating weak cash flow often disappointed investors later, sometimes catastrophically. Companies with cash flow that confirmed and supported their earnings tended to be more reliable long-term investments with far fewer unpleasant surprises. This does not mean that every divergence between earnings and cash flow is fraud or manipulation. There can be legitimate reasons for temporary differences. A company that is growing very rapidly may need to invest heavily in inventory and accounts receivable, which can use up cash even when the business is genuinely and profitably growing. But the key word here is temporary. If the divergence is persistent, if it shows up quarter after quarter or year after year, that is when it becomes deeply concerning and warrants serious investigation. Now let us talk about one of the most important places where earnings and reality can diverge, and that is in the area of revenue recognition. Revenue recognition is the accounting process by which a company decides when to record a sale as revenue in its financial statements. And the rules around this, even when they are followed correctly, give companies a surprising amount of flexibility that can be used to shape how the income statement looks in any given period. Consider a company that sells software. Does it recognize the full revenue from a software sale the moment the sale is made? Or does it spread that revenue over the life of a multi-year support and service contract? Under different accounting choices, the same business can report very different revenue and earnings numbers in any given quarter, even if the underlying economic reality is exactly the same. The management team that wants to show strong current results will naturally gravitate toward the choice that front-loads revenue recognition. Or consider a construction company that is building a large project that will take 3 years to complete. It can recognize revenue as the project progresses based on the percentage of completion. Or it can wait until the project is complete. The choice it makes will dramatically affect how its earnings look in any given period. And management will naturally be tempted to make the choice that makes current earnings look as good as possible, even if that does not reflect the true pace of value creation or cash collection. O'Glove teaches investors to be alert to companies that seem to be reaching forward in time to grab revenue that has not truly been earned yet. This is called premature revenue recognition, and it is one of the most common ways that earnings quality gets degraded. When a company recognizes revenue before it has truly earned it, the current quarter looks great, but it is borrowing from the future. Eventually, the future arrives, and there is a gap. Sales that should have appeared in later periods do not materialize because they were already counted in an earlier one. The signs of premature revenue recognition are often visible to the careful investor. One of the most important is a rapid increase in accounts receivable. Accounts receivable is the money that customers owe to the company but have not yet paid. When revenue is growing, but accounts receivable is growing even faster, that means the company is recording sales but not collecting the cash at the same pace. This can happen legitimately if the company is extending more credit to customers to drive growth. But it can also be a sign that revenue is being recorded before it is truly earned, or that customers are having difficulty paying and are therefore taking longer to do so. O'Glove always encourages investors to calculate what is sometimes called the days sales outstanding, which is a measure of how many days on average it takes the company's customers to pay their bills. When this number is rising over consecutive quarters or years, it is a warning that something may be changing in the quality of the company's revenue or in the creditworthiness of its customer base. Connected to the question of revenue recognition is the broader concept of comparing what a company reports with what its industry peers report. And this brings us to one of the most illuminating principles in the entire work, which is the power of comparison. O'Glove is a strong believer in peer comparison as an analytical tool. No financial number exists in a vacuum. A gross margin of 40% means nothing unless you know what the typical gross margin in that industry looks like. Inventory that has grown by 20% might be alarming for one kind of company and completely normal for another. The only way to put financial numbers in proper context is to compare them to relevant benchmarks, and the most useful benchmarks are the financial results of direct competitors operating in the same industry. When one company in an industry is reporting strong earnings growth while all of its peers are struggling, that is not necessarily a sign of exceptional management. It might be, but it might also be a sign that the company is using accounting choices to maintain an appearance of success that its industry position does not truly support. The serious investor always asks, If the industry is doing poorly, how is this company doing so much better? And if the answer is not a clear and compelling business reason, it is time to look more carefully at the accounting choices being made. This comparison process also applies to margins. Profit margins, which represent how much of each dollar of revenue a company keeps as profit, should generally be consistent with what is seen across an industry. When a company's margins are unusually high compared to competitors, it could mean they have a genuine competitive advantage, a superior business model, or a more efficient operation. But it can also mean they are deferring costs, cutting corners on things like maintenance and research and development, or using accounting choices that make current margins look better at the expense of future performance. A careful investor will always ask, what is the source of this margin advantage? If the answer is clear and structural, if the company has patents or network effects or a unique cost structure that genuinely sets it apart, then the higher margin is real and sustainable. But if the answer is murky, or if the advantage is not visible in the operations of the business, then the margin difference deserves a deeper look. Now let us go deeper into one of the most technically important areas of earnings quality analysis, which is inventory accounting. For companies that make or sell physical goods, inventory is a major part of the balance sheet. And the way a company chooses to account for its inventory can have a significant effect on its reported earnings, making it a critical area for quality assessment. There are two main methods of inventory accounting. The first is called first in, first out. The second is called last in, first out. The choice between these two methods may sound like a dry technical detail, but it can mean the difference between a company appearing highly profitable and appearing only modestly profitable, even when the actual economic reality of the business is identical. Here is how it works in simple terms. Imagine a company buys widgets to sell. In January, it buys 100 widgets at a cost of $10 each. In June, when prices have risen because of inflation, it buys another 100 widgets at a cost of $12 each. In December, it sells 100 widgets. Now, which widgets did it sell? The ones it bought in January for $10 each, or the ones it bought in June for $12 each? Economically, all the widgets are identical, but accountants must assign a cost to the sold inventory, and the choice of method determines which cost is used. Under the first in, first out method, the company uses the cost of the oldest inventory first, which in a period of rising prices means it uses the lower cost. This produces a higher profit on each sale. Under the last in, first out method, the company uses the cost of the most recent inventory, which in a rising price environment means it uses the higher cost. This produces a lower profit, but it also produces lower taxes, because lower profits mean lower taxable income. O'Glove helps investors understand that when comparing companies in the same industry, it is essential to check which inventory method each company uses. A company using the first in, first out method will look more profitable than a company using the last in, first out method during periods of rising prices, even if their underlying economic performance is identical. And if a company switches from one method to the other, it can produce a one-time boost to earnings that has nothing to do with any genuine improvement in the business operations. Similarly, when a company reduces its inventory during a period when it has been using the last in, first out method, something called a last in, first out liquidation can occur. The company dips into its older, lower-cost inventory layers, and the lower cost of that older inventory boosts reported profits. This is a temporary phenomenon that happens because of the mechanics of the accounting method, not because of any genuine improvement in the business. But without knowing to look for it, many investors would interpret the higher profits as a positive sign about the company's performance. The lesson here is not that one inventory method is better than another in an absolute sense. The lesson is that the choice matters, that it affects the numbers investors see, and that investors need to be aware of it when comparing companies and when assessing the sustainability of a company's reported earnings from one period to the next. Closely related to the issue of inventory accounting is the question of depreciation, and this is another area where accounting choices can have a dramatic impact on reported earnings, and where Oglove focuses significant analytical attention. Depreciation is the process of gradually recognizing the cost of a long-term asset over its useful life. When a company buys a piece of machinery for $1 million and expects to use it for 10 years, it does not record a $1 million expense in the year of purchase. Instead, it spreads that cost over 10 years, recording approximately $100,000 of depreciation expense each year. This seems straightforward, but the details create significant room for variation that affects reported earnings substantially. How long does the company estimate the useful life of its assets to be? The longer the estimated life, the lower the annual depreciation expense, and therefore, the higher the reported earnings will be in any given year. A company that says its machinery lasts 20 years will report lower depreciation and higher profits than a company that assumes an identical piece of machinery will last only 10 years. Both companies made the same economic investment, but they report very different earnings because of their different assumptions about asset life. Companies also have choices about the pattern of depreciation they use. Straight-line depreciation, the simplest method, spreads the cost evenly over the estimated life of the asset. Accelerated depreciation methods front-load the expense, recording more depreciation in the early years of an asset's life and less in later years. A company using straight-line depreciation will report higher earnings in the early years of an asset's life compared to a company using accelerated methods, even though the economic reality is the same. Oglove teaches investors to be alert to any changes in a company's depreciation assumptions. If a company suddenly decides that its assets last longer than it previously thought and extends the estimated useful life of its machinery or equipment, this reduces its current depreciation expense and automatically boosts reported earnings. The change does not reflect any improvement in the business or its competitive position. It is simply an accounting adjustment that flatters the earnings number. And yet, without knowing to look for it, investors might interpret the earnings increase as a sign of genuine business improvement. The notes to financial statements, which are the footnotes buried at the back of annual reports, are where these kinds of changes are disclosed. And this brings us to one of the most important and underappreciated lessons of the entire work. Footnotes are not optional for the serious investor. They are essential. They are where the company tells you things it would sometimes rather you not notice. The culture of financial reporting tends to put the best face on everything in the main body of the annual report. The letter to shareholders is almost always optimistic. The management discussion and analysis section highlights the positives and minimizes the negatives. But footnotes must be more complete and more candid. They are where accountants and lawyers must make disclosures that regulations require, even when the company might prefer to have investors overlook them. Oglove dedicates serious and sustained attention to the discipline of studying footnotes carefully. He identifies specific kinds of footnote disclosures that should immediately command the investor's full attention and trigger deeper analysis. Changes in accounting methods are one critical area. Anything that says the company has adopted a new accounting policy or changed an existing one should prompt a careful analysis of how much of any earnings change is due to the accounting change rather than to actual improvement in business performance. This is a mandatory disclosure, which means companies must tell you when they change accounting methods. But they often describe the change in language that is as bland and unthreatening as possible, hoping that investors will not stop to calculate the actual effect on the reported numbers. Contingent liabilities are another critical area of footnote disclosure. When a company is involved in lawsuits, regulatory investigations, environmental cleanups, or other potential obligations, these must be disclosed in the notes. Many companies use language that is as vague as legally permissible to downplay these risks, but they are real, and they can be enormous. A company that seems profitable and strong might have a contingent liability that, if it ultimately materializes, could consume years of earnings or even threaten the company's financial stability. The investor who does not study footnotes will have no idea this risk exists until it is too late. Related party transactions are another area that O'Glove highlights as deserving careful scrutiny. These are transactions between the company and its executives, directors, or major shareholders. They are legal and common, but they need to be scrutinized with care. When a company buys something from a business owned by its chief executive, how confident can an outside investor be that the price paid was fair to shareholders? When a company loans money to a subsidiary controlled by a major shareholder, what are the terms, and are they truly at arm's length, as they would be with an unrelated third party? Related party transactions are not always problematic, but they create potential conflicts of interest that investors need to understand and evaluate. Now, let us turn to the area of pension and benefit accounting, which is one of the most complex and least understood aspects of corporate financial reporting, and one that O'Glove addresses with particular care and analytical rigor. Large companies typically promise their employees retirement benefits. They may offer traditional pension plans, which commit the company to paying a fixed income to retired employees for the rest of their lives. They may offer post-retirement healthcare benefits. These promises create enormous long-term obligations that must be accounted for in the financial statements, and the assumptions underlying these calculations can have a significant and lasting effect on reported earnings. The key issue is this: a company must estimate what it will owe in future retirement payments. To do that, it must make assumptions about things like how long its employees will live after retirement, how quickly salaries will grow in the future, and most importantly, what rate of return it expects to earn on the money it has set aside in its pension fund to cover these future obligations. The expected rate of return on pension assets is particularly important in this context. The higher the assumed rate of return, the less the company needs to contribute to the pension fund each year, and the lower the pension expense that flows through the income statement. A company that assumes its pension assets will earn 10% per year will report much lower pension costs than a company that assumes only 6%, even if both companies have similar pension obligations and similar investment portfolios. This creates an obvious temptation. Companies can boost their reported earnings simply by raising their assumed rate of return on pension assets. The change is perfectly legal. It will be disclosed somewhere in the footnotes. But unless investors know to look for it, they will see higher reported earnings and think the business improved, when in fact, only an accounting assumption changed. O'Glove teaches investors to check the pension assumptions of any company with a significant pension program, and to be suspicious of any company that has raised its assumed rate of return in a way that is not supported by the actual historical performance of its pension investments. The gap between the assumed return and the actual return eventually must be reconciled, and when that reconciliation comes, it can be painful for reported earnings and for the overall financial health of the company. Related to pension accounting is the broader question of how a company handles its various reserves and provisions. Companies regularly set up reserves for things like product warranties, bad debts, and legal settlements. The amount that is set aside for these reserves reduces current earnings. But companies have significant discretion in determining how much to set aside, and that discretion can be used to manage the appearance of earnings. In good times, a company might be tempted to set aside too little for reserves, making current earnings look stronger than they would otherwise be. When bad news eventually arrives, the company has to take a large charge to cover the actual costs, which depresses earnings in a later period. Conversely, in times when earnings are already weak for other reasons, a company might set aside excessive reserves, taking a larger hit now that will actually benefit future earnings by reducing the costs that show up in those future periods. This practice is sometimes called cookie jar accounting, because it is like putting extra cookies in the jar during good times and pulling them out during lean ones to smooth out the apparent performance of the business. O'Glove is clear about why this matters for investors. When a company uses reserve manipulation to smooth its earnings, the apparent stability of the earnings record is an illusion. The business may actually be experiencing more volatility than the reported numbers suggest. And investors making decisions based on that apparent stability are working with incomplete and misleading information about the true dynamics of the business. One of the most straightforward ways to detect this kind of reserve manipulation is to track the ratio of a company's reserves to its relevant business metrics over time. For example, the allowance for doubtful accounts, which is the reserve a company sets aside for customers who may not pay their bills, should generally grow in proportion to the company's accounts receivable. If accounts receivable is growing rapidly, but the allowance for doubtful accounts is not keeping pace, the company may be setting aside too little for potential bad debts, which means current earnings are being flattered at the expense of future ones. Let us now address a critical concept that O'Glove introduces around the importance of tax accounting as a window into the true earnings of a business, because this is an area that many investors completely overlook and yet provides some of the most reliable signals about earnings quality. Taxes are a fascinating subject from the earnings quality perspective because companies operate under two different sets of accounting rules simultaneously. One set of rules is used for reporting earnings to investors, which is the generally accepted accounting principles that govern financial statements. The other set of rules is used for filing tax returns with the tax authorities. And because these two sets of rules differ in important ways, the income a company reports to investors in its financial statements is often different from the income it reports to the government. This creates what is known as a deferred tax liability or deferred tax asset. When a company reports more income to investors than to the tax authorities, it will have to pay those taxes later when the timing differences between the two systems eventually reverse. This creates a deferred tax liability on the balance sheet. When the deferred tax liability is growing rapidly, it can be a sign that the company's reported book earnings are running well ahead of its taxable earnings, which may mean the reported earnings have been enhanced by accounting choices that the tax system does not recognize in the same period. O'Glove points out that this comparison between book earnings and taxable earnings is one of the most powerful checks an investor can perform. If a company is consistently reporting high earnings to investors, but paying very little in taxes relative to those earnings, something deserves investigation. Either the company has legitimate tax deductions and credits that explain the gap, or there may be a quality issue with the reported earnings that is inflating the reported profitability, while the taxable profitability tells a different story. The quarterly tax provision is another area where close attention pays off for the alert investor. Companies estimate their tax liability on a quarterly basis, and these estimates can be used to manage quarterly earnings. When a company needs a better result in a particular quarter, it may adjust its estimated tax rate in a way that reduces the tax provision and boosts after-tax earnings. Investors who track the effective tax rate quarter by quarter and compare it to the prior year and to the company's own previously communicated guidance will sometimes catch these kinds of earnings management techniques before they become widely recognized. Now, let us explore one of the most impactful and least visible areas of earnings quality, which is the question of capital expenditures and how they interact with reported earnings in ways that can be deeply misleading for investors who do not look carefully. Every business needs to invest in physical assets to maintain and grow its operations. Factories need maintenance. Equipment wears out and must be replaced. Technology systems become obsolete. The money a company spends on these capital investments is called capital expenditure. The important thing about capital expenditure is that, unlike operating expenses, it does not flow directly through the income statement as a current period expense. Instead, it goes onto the balance sheet as an asset and is then gradually depreciated over time. This creates a powerful opportunity for earnings management through the misclassification of expenses. When a company classifies what should be an operating expense as a capital expenditure. It removes that cost from the current income statement and spreads it over future periods as depreciation. The effect is to make current earnings look higher than they actually are. The expense does not disappear. It is simply deferred into the future. But in the current period, the earnings number is flattered, and the investor who does not dig deeper sees only the better than warranted result. O'Glove teaches investors to watch the ratio of capital expenditure to depreciation carefully. When capital expenditure is significantly and consistently higher than the depreciation being charged against existing assets, it may reflect genuine growth investment. But when capital expenditure is only slightly higher than depreciation, especially in a company that has historically been a strong grower, it may suggest that the company is not investing enough to maintain its competitive position. A business that is underinvesting in its asset base to preserve current reported earnings is consuming its future to flatter its present. Free cash flow, which is the cash left over from operations after all necessary capital expenditure, is one of the truest measures of a business's health and genuine earning power. A company can report strong earnings and yet generate almost no free cash flow if its capital expenditure needs are very high relative to its operating cash flow. Conversely, a company with modest reported earnings but very low capital requirements might generate abundant free cash flow that the reported earnings figure does not fully capture. O'Glove consistently argues that investors should pay as much attention to free cash flow as to reported earnings, and in many cases, more. Free cash flow cannot be faked through accounting choices in the same way that earnings can. It is the real residue of genuine business value creation after all the costs of maintaining and growing the business have been paid. Now, let us discuss the question of acquisitions and how they can complicate and sometimes mask the true earnings quality of a company, because this is an area that has caused enormous losses for investors who did not understand its dynamics. Many companies grow through acquisition. They buy other businesses, fold them into their own operations, and report the combined results. This can create tremendous complexity for investors trying to assess earnings quality for several important reasons. First, acquisitions create goodwill. Goodwill is the excess of the price paid for an acquisition over the fair value of the identifiable assets acquired. It sits on the balance sheet as an intangible asset. The problem with goodwill is that it represents the hope that the acquired business will perform well enough in the future to justify the premium that was paid. And when that hope is not realized, the goodwill must be written down. But management has significant discretion in deciding when and how much goodwill to impair. A company that has made a bad acquisition may be reluctant to recognize the impairment because doing so would create a large charge to earnings that it wants to avoid. So the goodwill may sit on the balance sheet for years, giving the appearance of a solid asset base and making the company look financially stronger than it truly is, even when the underlying acquisition has not delivered the returns that justified the original premium. Acquisitions also complicate the assessment of organic growth, which is growth from the company's existing operations rather than from newly purchased businesses. When a company reports earnings growth, what portion of that growth came from the businesses it already owned, and what portion came from new acquisitions? The distinction matters enormously. Organic growth is much more valuable and sustainable than growth that is simply purchased through acquisitions, because it reflects genuine improvement in the company's competitive position rather than financial engineering through deal-making. A company that is growing its revenue by 20%, but whose existing operations are actually flat, with all the growth coming from acquisitions, is in a fundamentally different position than a company where existing operations are genuinely growing at 20%. O'Glove emphasizes the importance of stripping out the effect of acquisitions to see what the underlying business is actually doing on its own. Many companies do not make this easy for investors, which is itself a yellow flag. A company that is confident in the quality of its organic growth should be willing to show it clearly. Now let us turn to a subject that is particularly important for investors in certain industries, and that is the quality of earnings in companies with significant off-balance sheet commitments and obligations. Off-balance sheet financing refers to situations where a company has obligations or risks that are not fully reflected in the assets and liabilities shown on its balance sheet. This can take many forms. Long-term operating leases have historically not been required to appear as liabilities on the balance sheet, which could make a company's financial obligations look much lower than they truly were. If a retailer has committed to paying rent on hundreds of store locations for the next 20 years, those obligations represent real financial commitments that reduce future flexibility. But until accounting rules were changed to address this, they could be omitted from the balance sheet entirely, making the company look less financially leveraged than it actually was. Oglove's approach to off-balance sheet items is straightforward. Look beyond what the company chooses to show prominently. Study the notes. Ask what obligations the company has made that do not appear as liabilities on the balance sheet. Then, form an honest assessment of whether those commitments and risks are material enough to matter to the overall financial picture of the company. The investor who does this consistently will have a much more accurate picture of the true financial position of any business. Let us now spend considerable time on one of the most direct and practical concepts in the entire work, which is the idea of normalized earnings. Normalized earnings are the earnings a business would have reported in a given period if you stripped away all the non-recurring items, one-time events, and accounting adjustments that distorted the true underlying performance of the business. They represent an attempt to answer the question, if this business was operating under normal, steady-state conditions without the influence of unusual events, how much would it actually earn on a sustainable basis? This concept is enormously valuable because real businesses are always being influenced by events that are unusual, one-time, or non-recurring. A company might sell a division and book a large gain. It might take a restructuring charge. It might benefit from an insurance settlement. It might settle a lawsuit. It might have an inventory write-down. All of these events affect the reported earnings. The problem is that companies sometimes present items as one-time or non-recurring when they are actually quite recurring in nature. Oglove is particularly sharp on this point. He has observed companies that seem to have a restructuring charge nearly every single year. They call each charge a one-time event and ask investors to exclude it from their assessment of underlying earnings quality. But if a company is restructuring every year, the restructuring is not a one-time event. It is a regular cost of doing business, and it should be included in any honest assessment of true operating earnings. Similarly, companies sometimes present gains from asset sales as outside the ordinary course of business, when, in fact, they regularly buy and sell assets as a normal part of how their business operates. The gain might be genuine and legal, but it should not be treated as evidence of improvement in operating performance if the company is simply monetizing assets whenever it needs a boost to its quarterly number. Oglove teaches investors to be deeply skeptical of any company that repeatedly has large non-recurring items, whether gains or losses. And he teaches investors to look carefully at whether the non-recurring items being excluded from adjusted earnings tend to be gains and losses in roughly equal measure over time, or whether they systematically tend to be losses. If a company's non-recurring items are almost always charges and expenses rather than gains, then the pattern suggests they are a real and recurring feature of the business and its economics, not genuine one-off anomalies. The calculation of normalized earnings requires judgment. There is no formula that perfectly captures what earnings would look like in a normal year. But the effort to make this calculation is valuable because it forces the investor to think carefully about what is truly driving the earnings and what is simply noise that should be looked through. Now, let us address a concept that is particularly relevant for investors who follow businesses in cyclical industries, which are industries whose earnings go up and down significantly, depending on the broader economic cycle or conditions in their specific market. For cyclical companies, earnings at the peak of the cycle can look spectacular. and earnings at the trough of the cycle can look terrible or even negative. An investor who evaluates a cyclical company based on peak earnings will often dramatically overpay for the stock because those peak earnings are not representative of what the business earns on average over a full cycle. And an investor who looks only at trough earnings when the company is barely profitable or losing money might miss an excellent opportunity to buy a strong business at a temporarily depressed price. O'Glove advocates for looking at earnings over a full business cycle when evaluating cyclical companies. What is the average earnings power of this business across good years and bad years combined? This cycle average view is a much more reliable indicator of the company's true value than any single year's results, which may reflect either an unsustainably favorable environment or an unusually difficult one. This principle connects to the powerful force of mean reversion, which operates in business and financial markets over medium and long time horizons. Profit margins that are extraordinarily high today tend to attract competition that brings them back down toward normal levels over time. Margins that are depressed tend to recover as weaker competitors exit the market or conditions improve. Businesses do not sustain results that are dramatically above or below average indefinitely. They tend to revert toward the mean performance of their industry and the broader economy. An investor who understands mean reversion will be cautious about paying high prices for businesses with unusually high profit margins and earnings, because those margins and earnings may prove unsustainable. And an investor who understands mean reversion will recognize that a genuinely strong franchise trading at a low price because of temporary earnings depression may be a compelling opportunity that the market is missing. Let us now discuss the relationship between earnings quality and dividend policy, because this is an area where the signals from a company's behavior can be extremely informative about the true quality of its earnings. Companies that pay regular dividends make a commitment that is much harder to sustain with artificial earnings than a simple earnings announcement. A dividend is real cash that leaves the company and goes to shareholders. It cannot be faked. A company can manipulate its reported earnings number using accounting choices, but it cannot pay dividends with accounting entries. The cash must be genuinely there. This is why dividend-paying companies with long records of consistent or growing dividends deserve particular respect from an earnings quality perspective. If a company has maintained and grown its dividend through multiple economic cycles, that is evidence that its earnings are real and durable enough to support genuine cash payments year after year. It is easy for companies to report impressive earnings for a few quarters using accounting tricks, but it is very difficult to sustain those tricks while simultaneously sending real cash to shareholders year after year through a growing dividend. O'Glove teaches investors to look at the dividend coverage as a test of earnings quality. A healthy, high-quality earnings stream should be able to cover the dividend comfortably and still leave plenty of retained earnings for reinvestment in the business. When a company is paying out a very high proportion of its earnings as dividends, or when the dividend approaches or exceeds the level of free cash flow, that is a warning sign. Either the dividend is not safe, or the earnings themselves are inflated, because the cash simply is not there to sustain both the dividend payments and the reported earnings level. Dividend cuts and eliminations are among the most devastating events for shareholders, particularly those who are counting on investment income. And very often, when you look back at the financial statements leading up to a dividend cut, you can find the warning signs that O'Glove teaches investors to watch for. Earnings rising while cash flow is flat. The effective payout ratio consuming nearly all of the available cash. Footnote: disclosures of increasing debt or contingent liabilities. The story was always there to be found. But investors who looked only at the headline earnings number missed it every time. Now, let us move into a more behavioral dimension of earnings quality, which is the question of management credibility and its deep relationship to the quality of financial reporting that investors receive. Numbers do not exist in a vacuum. they are produced by people, and the character, incentives, and track record of the people running a business have a profound effect on the quality of the financial information that those people produce and present to the investing public. O'Glove is clear that management character matters enormously in earnings quality analysis. A management team that has a track record of honest, conservative financial reporting is far more likely to produce genuinely high-quality earnings than one that has a history of aggressive accounting, restated financial statements, or questionable practices that have attracted regulatory attention. This is why the history of earnings restatements is such a powerful red flag for any company an investor is considering. When a company is forced to restate its previously reported earnings, it means that the numbers it gave investors before were wrong. Sometimes, this happens because of honest mistakes, particularly in complex or rapidly changing accounting environments. But very often, it reflects a culture of aggressive accounting that eventually could not be maintained. And companies that have restated earnings once are statistically much more likely to have accounting problems again in the future, because the underlying culture has not changed. The incentive structure facing management also deserves careful consideration. When executives are heavily compensated through stock options or bonuses tied to reported earnings per share, they have powerful personal financial incentives to maximize that number in the short term. This does not mean that every executive with stock options or earnings-based bonuses will manipulate earnings. Most will not. But the incentive is there, and its existence should make investors more, not less, vigilant about looking behind the reported numbers for any signs of earnings management. Related to this is the increasingly widespread practice of companies presenting non-GAAP financial measures alongside their official accounting results. These are customized versions of earnings that companies create by adjusting the official results to exclude items that management considers non-representative of the true business performance. Non-GAAP measures can be genuinely useful when they strip away real noise to show the underlying performance of the business more clearly. But they can also be used systematically to present a far rosier picture than the official accounting results would support. O'Glove would encourage investors to look carefully at the relationship between a company's official accounting earnings and its customized adjusted earnings over time. If the adjusted earnings are consistently and significantly higher than the official results, and if the same adjustments keep appearing year after year because they are supposedly non-recurring, that is a sign that the company is presenting a more flattering picture of itself than the actual accounting results would sustain. The most credible companies are those where the gap between official and adjusted earnings is small and genuine, and where the adjustments truly are non-recurring events rather than regular features of the business. Now, let us turn to the very practical question of how an investor actually implements this framework when evaluating a real company for potential investment. The first step in any earnings quality analysis is to gather the right materials. This means the company's annual reports going back at least 3 to 5 years, and ideally longer for businesses with longer operating histories. It means the quarterly filings as well, because quarterly data can reveal patterns and trends that annual data, by averaging across seasons and events, smooths over. It means the footnotes, always the footnotes, studied carefully and completely rather than skimmed. And it means data on the company's peers and competitors, so that every number can be put in the proper context that makes it meaningful. The second step is to establish the trends. O'Glove is a great believer in tracking financial metrics over time rather than looking at them in isolation for a single period. A single year's numbers tell you very little with any confidence. 5 years of numbers tell you considerably more. 10 years tell you even more. You want to see how revenue has grown, how margins have evolved, how the relationship between earnings and cash flow has changed over time, how capital expenditure has related to depreciation, and how the key balance sheet ratios have moved. The trends are where the true story of a business is told. The third step is to do the comparisons. How does this company's performance compare to its peers on each of the key metrics? Is it reporting higher margins than the rest of the industry? Is its revenue growing faster than the overall market for its products? Is its accounts receivable growing faster than its revenue? Is its days sales outstanding rising or falling? Each of these comparisons can illuminate something important about the quality of the reported numbers and whether they reflect genuine business performance or something else. The fourth step is to analyze the cash flow statement carefully and in depth. The cash flow statement is the cornerstone of earnings quality analysis. O'Glove consistently returns to the theme that cash is truth. He wants investors to look at operating cash flow relative to net income over multiple periods. He wants investors to calculate free cash flow and to understand how it compares to the reported earnings. He wants investors to understand how the components of working capital, things like accounts receivable, inventory, and accounts payable, are moving from period to period and what those movements say about the health of the business and the quality of the earnings. The fifth step is to review the footnotes and the management discussion and analysis section in genuine detail, not just in the most recent filing, but comparing them carefully to prior years. Has the company changed any accounting policies? Have the depreciation or pension assumptions changed? Are there new contingent liabilities that were not disclosed before? Are there new related party transactions? Is management being more or less forthcoming and specific than in previous years? The evolution of these disclosures over time can be as telling as the disclosures themselves. The sixth step is to assess the tax accounting. What is the effective tax rate? How has it changed relative to prior periods? Is the deferred tax position growing in a way that suggests book earnings are running well ahead of taxable income? These questions take only a few minutes to answer once you know where to look, and they can be among the most revealing signals available to an investor assessing earnings quality. The seventh step is to adjust the reported earnings for any non-recurring items, accounting changes, or other factors that distort the underlying performance, and to arrive at an honest estimate of normalized earnings. This is a judgment-based exercise, and reasonable investors can disagree on the specific adjustments. But making the effort to arrive at a normalized earnings figure is far more valuable than accepting the reported number without any critical assessment. Once all of this has been done, the investor has a much clearer picture of what the business is truly earning, how dependable those earnings are, and what the trend of earnings quality looks like over time. And with that clearer picture, investment decisions become much more grounded in reality and much more likely to produce the kind of long-term results that serious investors seek. Let us now discuss an important practical implication of earnings quality analysis, which is its role in identifying stocks that represent genuine value and those that are dangerous despite their attractive surface appearance. O'Glove makes a nuanced point here that deserves careful attention. Earnings quality analysis is not a simple formula that says low quality equals sell and high quality equals buy. The relationship is more subtle and more interesting than that. What earnings quality analysis does is help the investor understand whether the price they are paying for a stock reflects what the business is truly worth, or whether that price is based on earnings that are inflated by accounting choices that will not persist. This is important because the market prices of stocks reflect the expectations of all participants. When the market prices a stock based on reported earnings that are of low quality, and the investor understands that those earnings are not sustainable at their current level, the investor has an informational advantage that can be translated into a better investment decision. And when the market prices a stock as though its earnings were of mediocre quality, when in fact they are of genuinely high quality, backed by strong cash generation, the investor who recognizes this also has an advantage. The investor who has done the earnings quality work can navigate both situations more skillfully than one who simply accepts the reported numbers. They can avoid the dangerous trap of paying a high price for earnings that are partly manufactured. And they can identify genuine bargains where the quality of the underlying earnings is better than the market has recognized. Oglove introduces the concept of an earnings quality spectrum that ranges from the most reliable and genuine earnings at one end to earnings that are almost entirely a product of accounting choices and management decisions rather than genuine economic performance at the other. Most companies fall somewhere in between, and the job of the earnings quality analyst is to understand where on this spectrum each company sits and to use that understanding appropriately in making investment decisions. Let us now address a few specific sectors and industries where earnings quality issues are particularly common and where the analytical work requires special knowledge and attention. Financial companies present unique earnings quality challenges that make them among the most difficult businesses for outside investors to assess. The core business of banks and other financial intermediaries involves lending money and managing financial risk, and both of those activities are inherently harder to see through than the operations of a company that makes or sells physical goods. The assets of a bank are primarily loans, and those loans are valued based on estimates of their likely future repayment. The creditworthiness of borrowers can change rapidly, particularly in economic downturns, and a bank can appear profitable for years by not adequately reserving against loans that are quietly deteriorating in quality, and then face enormous and sudden losses when those loans eventually default in large numbers. Oglove emphasizes that for financial companies, the quality of reserves for loan losses is particularly critical. When a bank's provision for loan losses, which is the expense it sets aside for potential bad loans, is unusually low relative to its loan portfolio or relative to what peers are setting aside, it may be inflating its current reported earnings by understating future losses. This pattern appeared before nearly every major banking crisis in modern financial history, and yet, investors who did not look carefully at the reserve adequacy consistently missed the warning signs until it was far too late. Insurance companies have their own unique earnings quality challenges that require specialized knowledge. Insurance profitability depends heavily on estimates of future claims, which are inherently uncertain and can take years or even decades to fully develop and be known. The reserves that insurance companies hold against future claims involve significant actuarial judgment, and there is meaningful room for managements to set those reserves in ways that either flatter or depress current reported earnings. Technology companies present yet a different set of earnings quality concerns. Revenue recognition has historically been a particularly complex area for technology businesses, especially those that sell bundled arrangements involving software licenses, ongoing support, and related services. The rules for allocating revenue among the different elements of a multi-element arrangement are complicated, and companies have significant latitude in how they apply them. Investors should pay close attention to how technology companies recognize revenue from long-term contracts and bundled offerings. Retail companies have earnings quality concerns centered around inventory valuation. The valuation of inventory for a retailer involves judgments about which items are worth less than their original cost because they are slow-moving, out of style, or damaged. When a company is consistently slow to take these write-downs, current earnings are artificially supported while a growing problem is quietly accumulating on the balance sheet. When the problem eventually becomes too large to defer, the sudden recognition of losses can devastate reported earnings for a quarter or more, shocking investors who had seen no warning in the headline numbers. Energy companies present earnings quality challenges related to the accounting for natural resource reserves. The value of an oil and gas company depends enormously on the reserves it claims to have in the ground. But estimating those reserves requires significant engineering and geological judgment, and the estimates can be wrong in ways that are not immediately obvious to investors. Companies that inflate their reserve estimates make their assets look more valuable than they truly are, and their earnings from the addition of new reserves look stronger than they genuinely are. In each of these industries, the specific mechanics are different, but the underlying principle from Oglove's work is the same. Earnings are an accounting construct, not a direct measurement of economic reality. They are shaped by estimates, judgments, and choices. The investor who understands this and who does the work to assess whether those estimates and choices are conservative or aggressive, sustainable or artificial, consistent or erratic, is working from a position of enormous advantage. Let us now address a crucial and often overlooked aspect of Oglove's framework, which is the temporal dimension of earnings quality. Not only is it important to assess the quality of earnings at any single point in time, but it is equally important to track how earnings quality changes over time, because the direction of change is often as informative as the current level. When a company's earnings quality is consistently high over many years, that is a very positive sign. It suggests that the management culture values honest reporting, that the business model genuinely generates cash, and that investors can trust the reported numbers as a reliable guide to economic reality. Companies with long records of high earnings quality tend to be excellent long-term investments. When a company's earnings quality has historically been high but suddenly begins to deteriorate, that is a very important early warning signal that deserves immediate and serious attention. Perhaps accounts receivable are growing much faster than revenue. Perhaps the effective tax rate has dropped sharply and inexplicably. Perhaps the footnotes are getting longer and more complex. Perhaps non-recurring charges are appearing more frequently than they used to. Perhaps the gap between reported earnings and operating cash flow is widening. Each of these changes in isolation might have an innocent explanation. But when several of them appear together, or when the trend is clear and persistent over multiple periods, the investor should pay very close attention and reassess the investment thesis. Oglove is particularly focused on tracking changes in accounting policies over time, because these changes often signal that a company is under pressure and is using accounting flexibility to relieve that pressure and maintain the appearance of performance. When times are genuinely good for a business, management rarely feels any compelling need to change accounting assumptions or adopt more aggressive revenue recognition policies. It is when the underlying business is weakening or facing headwinds that management becomes tempted to use accounting levers to maintain the appearance of strength. The investor who is tracking earnings quality over time can often spot this pattern early, before the market has recognized the deterioration and before the stock price has reflected it. The business problems that will eventually disappoint investors are already showing up in the accounting changes, the cash flow divergences, and the footnote disclosures. But only the investor who is looking will see them in time to act. Now let us think carefully about the broader relevance of this framework to how financial markets work and to the role of earnings quality in healthy capital allocation across the economy. Financial markets are supposed to allocate capital efficiently. When companies with genuine earning power can access capital at reasonable cost, and when companies with poor or deteriorating earning power face higher costs of capital or are unable to raise it at all, investment flows toward its most productive uses. This efficient allocation is one of the most important social functions that financial markets perform. But when financial reporting is unreliable, when companies can present artificially strong earnings through accounting choices without investors detecting the gap between the reported numbers and the underlying reality, capital allocation breaks down. Capital flows toward companies that look profitable on paper, regardless of whether they are genuinely productive. Businesses with real competitive advantages and genuine earning power may struggle to attract capital at reasonable cost because they cannot compete with the manufactured earnings growth of companies using aggressive accounting. This is why earnings quality matters not just to individual investors protecting their own portfolios, but to the health of the financial system as a whole. An investor community that demands high-quality, honest financial reporting, that does the analytical work Oglove describes, creates incentives for companies to be honest rather than to engage in accounting games. A sophisticated investor community that can distinguish genuine earnings from manufactured ones will direct capital more efficiently and more productively toward genuinely strong businesses. Let us now address a topic that O'Glove raises with particular insight, which is the institutional pressures that cause many professional investors to fail at the earnings quality analysis that he describes, and why this failure creates opportunities for individual investors willing to do the work. Professional investors, such as portfolio managers at large mutual funds and other institutional investment firms, operate under a set of pressures that are quite different from those facing individual investors. They are evaluated frequently, often quarterly or even monthly, against benchmark indices. They need to explain their investment decisions to clients, trustees, and compliance committees. They are acutely sensitive to how their portfolio looks relative to the market, because sustained underperformance relative to the benchmark can cost them their positions and their livelihoods. These pressures create a powerful bias toward following the crowd. When a stock is popular and rising, the institutional investor who avoids it because of earnings quality concerns risks looking wrong in the short term, even if they are right about the underlying issues. When a stock is cheap and hated but has genuine earning power, the institutional investor who buys it risks extended periods of underperformance while waiting for the market to recognize the true value. This herd mentality among institutional investors means that earnings quality issues are often overlooked for much longer than they should be, because no one wants to be the one who says the emperor has no clothes before the rest of the market has also recognized it. The individual investor, not subject to these same institutional pressures, is in some ways better positioned to take advantage of earnings quality analysis. The individual investor can hold a position through short-term volatility if the earnings quality analysis gives them genuine confidence in the underlying reality of the business. The individual investor can wait patiently for the market to recognize an earnings quality problem that has not yet been priced in. O'Glove recognized this potential advantage of the serious individual investor early in his career, and it is one of the central motivations for making his analytical framework accessible. He believed that by understanding the tools of earnings quality analysis, individual investors could make investment decisions that are genuinely better than those of many market professionals who, despite their resources, often failed to look beyond the surface of reported earnings. Let us now think about how this entire body of knowledge applies to building a long-term investment philosophy that is disciplined, evidence-based, and genuinely sustainable. The philosophy that emerges from this work is one that might be called evidence-based investing. It is the practice of making investment decisions based on a careful, skeptical, thorough analysis of the evidence provided in financial statements, rather than on the basis of enthusiasm, management promises, Wall Street consensus, or the narrative stories that companies tell about themselves. Evidence-based investing means following the cash as the primary test of whether reported earnings are real. It means understanding that reported earnings are not the same as economic reality and adjusting your analysis accordingly. It means doing the comparative work of putting a company's numbers in the context of its industry and its peers. It means studying footnotes rather than skimming them or ignoring them. It means being genuinely suspicious of consistency that seems too perfect or too good to be natural. It means asking, every time you look at a financial statement, not just what the numbers say, but why they say it, and whether the underlying business reality supports them. This approach requires a certain kind of temperament that not every investor naturally has. It requires patience, because the payoff from this kind of careful analysis often does not come immediately. Markets can remain irrational about a company's true earnings quality for a long time. But the investor who has done the analysis and understands the true picture can hold their position with confidence, knowing that the market will eventually catch up to the reality that the analysis has already revealed. It also requires a genuine intellectual humility. Even the most careful analysis can be wrong. Companies can surprise you in both directions. Accounting that seemed aggressive can sometimes turn out to be appropriate for the actual business dynamics. Companies that looked like they were managing earnings aggressively can sometimes genuinely improve their businesses and justify what had appeared to be inflated results. The goal is not to be right 100% of the time. The goal is to make decisions that are consistently based on a clearer, more realistic view of the evidence than the market consensus, because that approach will be right more often than alternatives that do not do the analytical work. One of the most powerful long-term outcomes of developing this kind of analytical discipline is the compounding effect of avoided mistakes. Investing returns can be destroyed more quickly by a few catastrophic losses than they can be built by a comparable number of excellent gains. And the most catastrophic losses in the history of stock market investing have typically involved companies where the reported earnings masked serious underlying problems that eventually and suddenly came to the surface. The investor who consistently avoids these situations, even if they also miss some opportunities by being too cautious, will build wealth more reliably over time than the investor who accepts reported earnings at face value and is periodically devastated by situations where those earnings turned out to be largely fictional. Oglove's framework provides an enormously valuable protective layer against these kinds of devastating losses. By asking the hard questions about earnings quality before investing, the careful investor significantly reduces their exposure to companies where the reported financial picture is materially different from the economic reality. And in investing, as in many other dimensions of life, consistently avoiding the big mistakes is often more important than consistently finding the big wins. Let us now address the role of auditors and the audit function in the earnings quality picture, because this is an area where many investors have misconceptions that can give them a false sense of security. When investors see that a company's financial statements have been audited by a major accounting firm, they often conclude that the financial statements can be trusted as an accurate representation of the company's financial position and performance. And up to a point, this is reasonable. Auditors do provide an important check on outright fraud and material misstatement. But the audit function has important limitations that Oglove would want every investor to understand clearly. Auditors do not certify that a company's financial statements are the most accurate or most conservative representation of its financial reality. They certify that the financial statements have been prepared in accordance with generally accepted accounting principles and that they are free from material misstatement. But as we have seen throughout this discussion, there is enormous room within generally accepted accounting principles for choices that favor one picture over another. Depreciation assumptions, inventory methods, revenue recognition policies, pension return assumptions, reserve levels, all of these are within the range of what an auditor can sign off on without requiring any changes. In other words, an audit does not guarantee high-quality earnings. It guarantees that the company has followed the applicable accounting rules. But within those rules, there is very significant room for management to shape the reported results in the most favorable possible way. And the auditor's job is not to insist on the most conservative or most realistic interpretation. It is to ensure that the chosen approach is within the acceptable range. Furthermore, auditors have a complex and sometimes uncomfortable relationship with the clients they audit. They are paid by the company whose financial statements they audit. The relationships between audit firms and their large corporate clients are often long-standing and financially significant. This does not mean that auditors routinely compromise their independence or sign off on things they should not. The vast majority of auditors are honest professionals, but it does mean that the existence of an audit does not relieve the investor of the responsibility to assess earnings quality independently. Oglove's work was written in part as a response to the reality that external auditors, important as they are, cannot substitute for the investor's own careful analysis of the financial statements. The audit provides an important foundation, But the earnings quality analysis that truly protects investors must be done by the investors themselves, using the frameworks and tools that he describes. Now let us discuss how the concept of earnings quality intersects with the question of valuation, which is ultimately how investors translate their analytical findings into investment decisions. Valuation is the process of determining what a business is worth and then comparing that worth to the current market price to see whether the stock is attractively priced, fairly priced, or overpriced. The most common approaches to valuation involve some measure of a company's earnings or cash flow, and this is exactly where earnings quality becomes directly relevant to the valuation process. The most widely used valuation measure is the price-to-earnings ratio, which compares the stock price to the annual earnings per share. A stock trading at a price-to-earnings ratio of 20 is priced at 20 times its annual earnings. Whether that is expensive or cheap depends on many factors, including the quality of those earnings. High-quality earnings justify a higher multiple because they are reliable, sustainable, and backed by cash. Low-quality earnings deserve a lower multiple because they may not persist at their current level. When two companies are trading at the same price-to-earnings multiple, but one has significantly higher earnings quality than the other, the one with higher quality earnings is a better value. Its earnings are more reliable and more likely to support the stock price over time. The one with lower quality earnings is at risk of disappointing investors when the accounting choices that have been supporting the earnings level can no longer be sustained. This is why understanding earnings quality is not separate from valuation. It is an essential input into valuation. A price-to-earnings analysis without an assessment of earnings quality is incomplete and potentially misleading. The investor who applies a 20 times earnings multiple to high-quality earnings is doing something fundamentally different from the investor who applies the same multiple to low-quality earnings, even though the arithmetic looks the same on the surface. Oglove teaches investors to think about what he effectively calls a quality-adjusted valuation. Rather than simply asking whether the stock price looks cheap or expensive relative to reported earnings, the investor should first ask whether those earnings are real and sustainable. If they are not, the apparent valuation is based on a false premise, and the stock may be far more expensive in true economic terms than the reported price-to-earnings ratio suggests. This quality-adjusted approach to valuation has important practical implications. It means that a company with very high earnings quality might deserve to trade at a higher price-to-earnings multiple than a company with lower earnings quality, because the quality of the underlying earnings is more valuable to investors. And it means that a company trading at what appears to be a low multiple, but with very low earnings quality, may actually be quite expensive in true economic terms once the earnings are properly quality adjusted. Let us also discuss the importance of understanding earnings quality in the context of long-term compound returns, because the mathematics of compounding amplifies both the benefits of high-quality earnings and the damage from low-quality earnings in ways that are not immediately obvious. Compounding is the process by which investment returns generate further returns over time, creating an accelerating accumulation of wealth for the patient, long-term investor. The power of compounding depends critically on two things: the rate of return achieved over time and the consistency with which that return is generated. Even a small difference in the annual rate of return, sustained over many years, produces enormous differences in the final accumulated value. High-quality earnings contribute to compounding in a directly valuable way. A business that genuinely earns its reported profits has real cash that it can reinvest in the business or return to shareholders. When those reinvested earnings generate further earnings, the compounding process is genuinely working as it should. The business is creating real wealth, period after period, that accumulates over time into something substantial. Low-quality earnings interfere with this process in a dangerous way. When a company is reporting earnings that are partially or largely a product of accounting choices rather than genuine cash generation, those earnings are not truly available for reinvestment in the same way. The company may not actually have the cash that its earnings imply. And when investors price the stock based on those earnings and pay a premium for the apparent growth, they are often setting themselves up for a painful reassessment when the true picture eventually becomes clear. The long-term investor who consistently invests in businesses with genuinely high earnings quality and who avoids those with low earnings quality will experience a dramatically smoother and more reliable compounding process over time. And because compounding is so powerfully sensitive to consistency, that smoother experience translates into meaningfully better long-term outcomes, even when the annual rate of return is not dramatically different in any given year. Now, let us address a critically important concept that O'Glove introduces around the distinction between a company's reported earnings history and its true economic history, and why this distinction matters so much for investment decisions that are supposed to be based on the past as a guide to the future. When investors and analysts project future earnings for a company, they typically start with the reported historical earnings as their baseline. They look at the trend, identify the growth rate, and project that growth forward to estimate what the company will earn in future years. This estimated future earnings stream then forms the basis for valuation. If the historical earnings have been inflated by accounting choices, the projections built from them will also be inflated, and valuations built on those inflated projections will lead investors to pay too much. This is a systematic error that compounds itself over time. Each year of inflated reported earnings gets built into the historical record that analysts and investors use as their starting point for projections. The base upon which future growth is projected becomes gradually more detached from economic reality, and the stock price, driven by the inflated projections, becomes increasingly vulnerable to a sharp correction when the accounting choices that have been supporting the reported earnings level can no longer be maintained. O'Glove's emphasis on normalizing earnings for this very reason is therefore not just about understanding the current year's performance accurately. It is about ensuring that the historical record on which future projections are based is itself an accurate reflection of the true economic performance of the business over time. When you start from a normalized, economically honest historical record, your projections are more likely to be realistic. And when your projections are realistic, your investment decisions are more likely to produce the outcomes you expect. Let us now address a dimension of earnings quality analysis that is particularly relevant for investors who participate in global markets and invest across different countries and accounting regimes. The principles of earnings quality analysis that O'Glove describes are universal. The imperative to follow the cash, to assess whether reported earnings are backed by real economic performance, to scrutinize accounting choices and their effects on reported numbers, these apply to any company anywhere in the world. But the specific implementation of these principles varies across jurisdictions because accounting standards and reporting requirements differ significantly from one country to another. Companies that report under international financial reporting standards, which are used in many countries around the world, may have different choices available to them than companies reporting under the United States generally accepted accounting principles. The specific rules for inventory valuation, revenue recognition, and asset impairment differ between these two major systems. And companies in countries with less developed or less strictly enforced reporting standards may have even more latitude in how they present their financial results. For investors in global markets, this means that the earnings quality analysis framework needs to be adapted to account for the specific reporting environment in which each company operates. The investor who understands the accounting standards being applied to a particular company's financial statements is better positioned to identify where the significant choices and judgments lie, and to assess whether those choices are conservative or aggressive. Disclosure quality also varies dramatically across markets. Companies in markets with strong regulatory oversight and enforcement tend to provide more complete and reliable disclosures than companies in markets where regulatory oversight is weaker. Investors in global markets need to factor in the quality of the overall reporting environment, not just the specific choices made by an individual company when assessing how much confidence to place in the reported financial results. Now, let us discuss one final but critically important element of the analytical framework, which is the role of competitive dynamics in assessing the sustainability of a company's earnings quality over time. A company's earnings quality is not determined solely by its accounting choices and the reliability of its cash generation. It is also shaped by the competitive dynamics of the industry in which it operates. A company with genuinely high earnings quality that operates in a highly competitive industry with low barriers to entry may find that its strong earnings attract competitors who erode its margins and cash generation over time. And a company with currently strong earnings quality that depends on a genuinely durable competitive advantage, a true economic moat, is far more likely to sustain those high-quality earnings over a long investment horizon. O'Glove would encourage investors to think about the sustainability of earnings not just through the lens of accounting quality, but also through the lens of competitive positioning. The most reliable long-term investments are those where the earnings are of genuinely high quality in the accounting sense, backed by strong cash generation and conservative reporting, and where those earnings are protected by a durable competitive advantage that makes them unlikely to be competed away over time. When both of these conditions are present, high earnings quality and a strong competitive moat, the investor has found something truly valuable. The earnings are real, they are backed by cash, and they are likely to persist and grow over a long time horizon. These are the characteristics of the truly great businesses that have produced the best long-term investment returns in financial history. The great investors throughout history have understood this connection, perhaps without always articulating it in the specific language of earnings quality analysis. They have been drawn to businesses where the numbers were trustworthy, where the management was honest, where the cash supported the profits, and where the competitive position made those profits likely to persist. This is exactly what O'Glove's framework helps investors find. Now, let us come to the final reflections on what it means to be a truly informed investor who has absorbed and internalized these principles. We live in an age of information abundance. Financial data is available instantly and freely to anyone with an internet connection and a willingness to access it. Earnings reports are released simultaneously to all investors. The playing field in terms of access to raw financial information has never been more level than it is today. And yet, the gap between investors who make consistently good decisions and those who consistently disappoint themselves remains very large. The reason for this gap is not access to information. It is the quality of analysis that investors apply to the information they have. And quality of analysis starts with quality of questions. The investor who asks the right questions about the financial statements in front of them is the investor who will make better decisions than the one who accepts the numbers without question and without deeper investigation. Every financial statement you ever encounter from this point forward should be approached with the same foundational set of questions. Is the cash there to back up the reported earnings? Have the accounting policies changed in ways that flatter the numbers? Are the footnotes revealing risks that the main body of the report downplays? How do these numbers compare to what peers and competitors are reporting? Are the earnings consistent with the true economic condition of the business and the broader industry? When you make these questions automatic, when they are part of how you naturally think, whenever you encounter a company's financial results, you will be a genuinely different kind of investor than you were before. Not just better informed, but more thoughtful, more skeptical in the best possible sense, more honest in your assessment of what the numbers actually mean. You will stop being impressed by a high earnings per share number without first asking what is behind it. You will stop accepting management's assurances that one-time charges are truly non-recurring without asking whether the same kinds of charges have appeared before. You will stop looking at a rising stock price and assuming it reflects real value creation without first asking whether the earnings that are driving the stock are real and sustainable. Instead, You will follow the cash. You will study the footnotes. You will compare to peers. You will track the trends. You will normalize for unusual items. You will assess the management team's track record of honest reporting. And you will arrive at your own independent judgment about what the business is truly earning and what that is genuinely worth. That is the practice of earnings quality analysis. And that practice, applied consistently and with discipline over a long investment career, is one of the most reliable paths to genuinely superior investment outcomes. The principles in this work are not time-bound. They do not go out of style when accounting rules change or when new industries emerge. As long as companies report financial results to investors, and as long as those reports involve judgment, estimation, and accounting choice, the discipline of earnings quality analysis will be essential for anyone who wants to invest wisely and well. The specific techniques may evolve as the reporting environment evolves, but the underlying imperative to understand what the numbers truly mean and whether they reflect economic reality is permanent. That imperative is now yours. The framework is yours. The questions are yours. And the discipline to apply them consistently through every market cycle, through every moment of enthusiasm and every moment of fear, is something you will build through practice and through the humbling experience of applying careful analysis to real situations over time. But the foundation is here. The understanding is here. And with it, you are prepared to approach every financial statement, every earnings announcement, every investment opportunity with the clarity, the skepticism, and the intellectual honesty that the best investors have always brought to their work. The quality of what you invest in will determine the quality of what your investments deliver. And now, you know how to tell the difference.